please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Bank Nifty down 844 points. We have the mid-cap index, which has recovered a little bit, but we're still down 639 points in terms of an absolute basis. We have Manisha joining in to discuss what's happening, however, in the commodity and the currency space. And I'm sure it is live with action, especially in the currency space, and not to mention even cryptocurrencies.
Oh, well, absolutely. Crypto assets, as we have been told to call it now. But, well, yes, the dollar index holding firm has led to most of the Asian currencies declining. The Indian rupee itself is trading the lowest since December 18, and that of course is bothering the calculations that we have seen in the Indian markets when it comes to commodities as well. So while you have seen a deeper correction continue for the crude oil prices, which is trading a percentage point on the lower side, there is some safe haven buying that has come back in case of the precious metal space. So while the global markets have seen 0.5% of gain come back for gold and silver, the Indian markets have reacted even higher because of the rupee calculation. And there you have 0.25% up on gold, 1% up on silver, and the Indian markets, as I said, have done immensely better than that. The industrial metal prices, while the New York session was very strong yesterday, haven't been able to hold on to the Asian markets right now. So we have seen some profit taking come in there as well. So everything from copper to nickel, actually, which has seen a 2% decline, is how we have reacted to the global sell-off in sense of industrial metals as well. David Lennox then joins us to talk more about that. David, hi. Let's start with precious metals, because that is the only sector that actually is trading in the green. Would you call it safe haven buying? Is it a very knee-jerk reaction to what we are seeing in sense of the global markets?
Oh, good morning, Manisha. Yes, look, one would have to suggest that the initial reaction in the gold price has been one of investors looking to perhaps pick up some safe haven positions. Now that we've seen somewhat of a follow-through with the fall that we saw from the Dow Jones on Friday, following through into Monday and possibly even overnight. So when that happens, we do see investors very quickly start to fret about the safety of risk-on assets, and we see that move over to gold, where we've seen, as you said, the gold price has actually risen over the course of the last couple of trading days, and that bodes well, we think, for the yellow metal in the next couple of days as well.
What is your sense on the long-term prices? Is it a good time to go long for gold and silver right now?
Look, certainly if you have a look at our prognosis for the rest of this year, we do think that the gold price will move higher. And that is primarily on the back of the fact that we've been suggesting that in 2018, inflation, which has started this unfortunately equity route, inflation will raise its head in 2018. And if any indication of the markets move on Friday with the first perhaps sentiment towards rising inflation coming into the market for this year, then we've certainly believe that that's going to again push the gold prices higher. We've kept our end of year target at this stage at between 1550 to 1600 US for the gold price. So there is a ways to go yet, but if inflation does come into the system over the course of 2018, that will, we believe, push the gold price where we want it to go.
David, also, how are you looking at the industrial metal space? Because while yesterday was a strong day, we have seen that area get into profit taking as well right now. How would you want to deal with this sector for the short term and slightly longer term as well?
Certainly over the longer term, we believe the scenario that we've been painting for some time, and that is that synchronised global growth is now with us. That we believe will push the commodity prices once we've gotten through this uncertainty of rising inflation over the near term. So once that's behind us, then the scenario remains very much in place for better global growth in 2018. And with that, we will see demand for commodity prices certainly far better than we've seen in 2017, and that will push the prices higher. In the near term, we are seeing that knee-jerk reaction to that higher inflation and the risk-off trades that we're seeing in the equity markets. That's flowed through to the commodities. We saw some recovery, Manisha, as you said, overnight with a slightly better US dollar. That brought some buying back into the commodities, but unfortunately it hasn't been able to be sustained over the day trading, and we've seen those prices start to ease off.
Well, yes, day trading has seen some decline, but the longer-term fundamentals string very, very positive. David, thank you so much for joining us with that cue on the metals as a space. But Finance Minister, of course, spoke to Network 18 exclusive, and oil price rise holding around $70 is something that he sees as a concern going forward. Let's listen in.
Finance Minister, with higher crude oil prices and a higher MSP, inflation could become a bit of a headache in the coming months. Are you concerned?
Well, certainly we are keeping an eye. As I said, experts tell me that the impact of the MSP would be somewhat there, but not much. It could be absorbed. As far as oil prices are concerned, as I've already said, we are almost on the outer periphery of comfort. And therefore, if it rises further, then of course it throws up a challenge as far as inflation is concerned.
Okay, and we will come to know what the RBI is thinking about inflation as soon as tomorrow afternoon. So do watch out for the RBI policy. But now, as of now,
100 points on the Nifty, 10,363 is where we're at, 3.7% lower. You know, we kind of sort of recover a little bit and then go back to being down, you know, more. So the Sensex down 1,000 odd points or so as we speak. Let's get Mitesh Thakkar in. Mitesh, thanks very much. Good to have you with us here. I mean, your sense on where we are headed and what would you like to do now?
Prashant, so basically, you know, I think we've clearly been going through a downtrend and the idea should be to sell on rallies. We got one yesterday. I think in case you get pullbacks like that, I think I would be comfortable more trading on the sell side. I think we are quite oversold, so pullback should happen most likely by afternoon or early tomorrow morning. And I think, you know, once we get closer to about 10,450, 500, I think that's the best area to possibly start exporting shorts again. So for the timing idea, if somebody has been having short positions, good time to take profits and you know, trade on stock specific basis. Yes, that's still on.
Nitish, what would your stock strategy be? And what do you think would actually lead this sort of upside that we could see that you're talking about?
See, I think mostly it could be short covering. I think, as I said, we are quite oversold and, you know, we've had a fall of roughly about 800 points in the matter of last 3 trading sessions. So I think, you know, profit booking on the short side and short covering will happen. Plus some kind of buying might emerge at lower levels. So I'm not looking at a reversal, but I think a throwback, especially given the fact that, you know, prices are way away from their intraday averages. That's a reading which I have not seen for a number of months now. So in that sense, I think a stop and a pullback is very likely. Coming to my stock specific calls right now, Equitas has broken support levels. So sell with a stop at 136, look for targets of 120. And I have one buy call as well. I'll explore some buying. As I said, I think Excite is something which is very close to support zones. So around 199 if it comes, buy with a stop at 193.5, look for a bounce back to about levels of 210.
Mitesh, thanks very much. Good speaking with you, and we speak with you in a bit from now again.
Well, just want to point out 2 parameters. One is the advanced decline ratio on the National Stock Exchange as well as on the Bombay Stock Exchange, and we're not seeing any sort of respite coming in there. So it currently stands at around 93 stocks advancing, maybe 99 now, to around 2,000 stocks declining. So that's the kind of advanced decline ratio we're working with. And the other key thing to watch out for is the India VIX. Yes, we saw that huge jump up that took place in the US markets in terms of the VIX, but the India VIX is up 20%. 29% rather. It's up around close to 30% at this point in time, and for the year itself the India VIX has jumped over 60%. So do watch out for that volatility index. But Rahul Arora of Nirmal Bang Institutional Equities is now with us. Rahul, hi, morning. We were reading your note, and one of the things that stood out is basically how you expect bond yields to probably determine what's going to happen with equity markets as well. We're going into an RBI policy tomorrow. Do you expect them to probably soothe the bond markets in some of their commentary?
So, Ekta, I think our economist Teresa's call for the last 6 months has been that we will see at least 1 rate hike in the calendar year 2018. It was a little ahead of the curve call when the market was talking about a cut. Speaking to her yesterday, she expects about a 40 to 50% chance he might hike tomorrow. Predominantly because of the fiscal deficit number that's come through in the budget. I think also anticipating what's happening in the US. So I think probably moving from 1, probably 2 rate hikes this year. I think she's expecting the bond yield to head closer to 8% by the end of the current quarter, by March end. So I think if that happens, that will have a significant impact on the way equities move. But I think as an asset class, I think bonds and the way it's moving globally, not just in India, I think globally bonds will have a very overpowering impact on the way equity markets pan out this year, especially because you're looking at liquidity withdrawal, inflation rising in developed markets as well as India, and interest rates rising. So I don't think it's going to be just about earnings growth from here. I think there'll be a very large shadow of the way the bond markets in India and globally perform on the equity markets.
Rahul, so just to put everything together, what's your view, I mean, in terms of the market itself? I'm talking about the stock market from here.
So I think, Prashant, if you go with consensus numbers as they stack up right now, they're working with about a 15% earnings growth for FY19 and about a 20% earnings growth for FY20, ceteris paribus. Of course, this would change if crude heads towards 80 and things like that. But let's look at it as things stand currently. I think then you're looking at the Nifty somewhere close to the end of the correction. I mean, maybe another 5% would probably be fair value on FY20 numbers, because as we have discussed in the past, and just to take off from the bond, yield question, the bond yield is telling you that the market PE should be somewhere around 14. The peak of this market was 11,172. At that time, you were trading at 22 times FY19 and close to about 19 times FY20. So I think that has corrected to a large extent. So I don't think from a fundamental perspective, if these numbers come through, there's a big contingent on if, then I think the Nifty could probably find a floor somewhere between 9,700 and 10,000, assuming this correction is to persist on fair value as it stands today. So I think I wouldn't advise people to come in and start buying right away. I don't think there's any merit in catching a falling knife, because if you're going to buy a stock for about at least 2 years now, given that LTCG has also come through, if you're buying a stock for a 50% appreciation and you get in 10% after it's gone up, and even if you don't cash the last 10%, you made a good 30%. So I don't think there's any point being brave. Wait for it to correct, wait for some signs of the reversal and then buy. I'm not one to sort of call an immediate top or a bottom on the market, but given the numbers that consensus has, and we're not too far away from that at our broking house, I don't think there's too much on fundamental value given those numbers in terms of a downside.
And once the market sort of falls, say another 5% or so, say to 97, 10,000 as you said, after that, do you expect a return of the so-called go-go type of phase in the market, or do you think that is now over? At least for now.
See, Prashant, I have a very different view to a lot of people you'll be talking to. I think a lot of people, and I follow your channel very closely, and I don't agree with people who say, I heard after 10,000 people said the bull market is just starting. My point is, what has happened in the last 4 years then? Your Nifty went from 5,000 to 11,000. If that was not the, the best bull market in recent memory, I don't know what people were expecting.
Somebody said 10,000 bull market is beginning.
I believe so. And I don't think you would want me to take the names on your channel, but it's absurd when you get those kind of views that come in, and it sucks in the retail investor. And you just look at the NFOs that have come out. Take the top 10 mutual funds in the country. They've all raised anywhere between 500 to 3,000 crores after the Nifty has crossed 10,000. A lot of people spoke about the linearity of this bull market. It's never going to happen. Nobody can time when the correction happens. The writing was on the wall. It may not have happened at 11,000. It would have happened at 12,000. But it was always going to happen. It was not that it was not going to happen. So, I've been asked to do a lot of calls with my retail clients today as well, at least on the other side. And I've been telling them there's no point trying to catch a falling knife at all at this point in time. It doesn't make sense.
Okay. Are they redeeming their mutual funds?
It's a tough call, Ekta, because this has been a domestic liquidity-led rally, and the systematic investment plan flows have not been tested. People, if the market was to fall, say, another 10% from here, people will start getting jittery. The biggest concern I have is the market has become unidirectional in terms of asset allocation. People are not looking at real estate and gold and have put all their eggs in one basket. So the extent of the loss could be much, much more than it was, say, in at other point in time where people had investments in real estate and gold. I think that's the one fundamental mistake people have made and the market has got into, is ignoring all other asset classes and putting their money into equities. This is people's savings that are going in. So I think, if you start seeing another 5-7% correction, people will start getting jittery. That being said, it is a good asset class. It's a fantastic asset class to be in. It's going to compound your money substantially over the years. If you're brave enough, I would suggest don't listen to me or anybody else that comes on television. Just take a call on what you think is the right value to play for stocks. There are still stocks that are going to grow their earnings by 15-20%, regardless of the Nifty falling down. Whether they're in consumer, whether they're in auto, whether they're in pharma, whether they're in IT, depending on which sector you like. And there'll be stocks. If you are brave enough to go in there and your value has come, I'd suggest go in and start buying. if you have the conviction. I would not advise it, but it is always, the theory of relativity always plays out in markets.
Okay, all right, Rahul, we've completely run out of time. Thanks very much for joining in and chatting with us about the markets. Well, for the Nifty, we're down around 301 points. The Sensex still showing a cut of around 1,000 odd points. Well, for the Nifty, we're down around 310 points. We do have a lot of earnings to reckon with today. We have Hero MotoCorp, which will be releasing its numbers, and besides that, we have Lupin and Punjab National Bank as well. Let me just give you a quick brief in terms of what we can expect from Lupin this time round. It will be the US markets which will probably play truant again for Lupin this quarter, and we are expecting a revenue decline of around 12.2% on a year-on-year basis, with margins coming in at around 21%, which would show a year-on-year decline, but it will be stable or flat on a sequential basis. The profit also likely to decline over 30-odd%. Like I mentioned, North America would be the key market to watch out for. It's 35% of their total revenue, and Q2 you saw the double-digit decline that we saw in the North American market because of the kind of pricing pressure that we've seen in the key products, which is flashing on your screen, diabetes drug, Fortimed, Glumetza, as well as Ministrin. So that would be important. Plus, we do have a high base to reckon with as well. In terms of the commentary, I think the most important to watch out for in terms of commentary would be, one, the picture with regards to the US pricing pressure, plus what's happening with regards to the Goa plant as well as the Pithampur Unit 2, both of which have a warning letter which they had received some time ago. So remediation on that, what the timeline of fixing it would be, and when it would probably start supplying back into the US markets, and a probable reinspection would be something that the markets would look forward to quite keenly. But PNB, it's expected to probably come out with numbers anytime soon, and I think slippages will be the top of mind figure considering the Q-on-Q decline that we had seen in Q2. Abhishek is here to apprise us of what we can expect from there.
Well, Ekta, as you pointed out, asset quality will be in focus. So slippages below 3,500 crore will be positive. Now, remember that one of the analysts, that is IDFC Securities, is pegging slippages at 4,500 crore. Last quarter, it was at 3,460 crores. Now, remember that the bank has raised about 6,315 crore from, preferential issue via QIP and through stake sale in PNB Housing in Q3. And government has also promised them about 5,500 odd crores in the upcoming recapitalization of PSU Bank. So overall, 11,800 crore of capital infusion will be in PNB Bank in H2 FY18. Now, loan growth momentum in double digits will be positive. Net interest margin, which they have been showing about domestic business, last quarter it was at 2.62%. Any improvement over there will be positive. Gross NPA improvement, last quarter the gross NPA was at 13.3%. Any improvement over there will be positive. Now, our polls suggest an NII growth of 10.5% and net profit on account of low base in the previous year Q3 to grow at 169%. But if you look at Q-on-Q, NII is expected to grow at 2.7%, while net profit to remain flat. Back to you.
Okay. Well, just to point out a couple of stocks within the broader markets which are showing a lot of pain and pressure. Vakrangi is locked in circuit again, so that stock, it's down around 9-odd%. And this week itself, just in the past two trading sessions odd, it's lost around 19-odd%. It's down 49% on a year-to-date basis. So that's Vakrangi for you. The other one has to be something like Just Dial. The margins improved this quarter. Nothing really wrong with the numbers, but that stock down 7.5-odd% today. And month to date already it's lost around 20-odd%. And the other one which really comes to mind is Fortis, and what's happened with that one. It's almost testing 100 rupees for Fortis now. And ever since the Delhi High Court order with regards to the Daiichi Fortis case, that stock has seen a steep decline. In fact, I think from the 25th of Jan, it's lost a huge amount in terms of, I think, over 20-odd% since the 25th of Jan. So that just gives you a roundup in terms of specific stocks in the broader markets. But as of now, we need to wrap up the show. We're going to leave you with some global opinion on what's happening with the sell-off in global markets.
What's really, really important for the market is to hold on to the 200-day moving average. If we can hold that level, then that should trigger some improvement in sentiment and a pickup in flows back into the market, I would suggest. Conversely, if we break through the 200-day average, then that opens up the risk of a wider correction. But at that 200-day average, we'll be down about 12% from the peak. Right. We're in firm correction territory. Given the fundamental backdrop, I'd be comfortable accumulating around those levels.
We got two reports back-to-back that said inflation may be worse. It wasn't that interest rates were rising, it's that wage inflation became a concern, and the market took it seriously. Do I think that it ultimately damages the rally? No. But it's something people are going to be focusing a lot more on. The earnings season is crazy good. The 2018 numbers are rising, and what people don't realize is with earnings estimates going up so much, the multiple on stocks is a full multiple point lower than it was on the day before the taxing passed. So this argument that stocks are looking cheap or expensive or frothy just doesn't hold anymore.